Hey everybody, my name is Johnny, and in today's video we're going to be talking about the benefits of picking your own stock and why that might be the best option for you. Now in my last video, I did a video on what a stock is and how the stock market works, and I just give a very basic explanation of that. And that was the first in the videos that is going to, in a series of videos that's going to detail from bottom to top how to go about picking your own stock and being a successful investor in that way. So when you go ahead and decide to invest in the stock market, there are basically three options that you have. You can A, invest in an actively managed mutual fund. Now what a mutual fund is a collection of stocks, and they are picked out for you by a fund manager, right? So you don't do any work, you just invest in the fund, you buy a portion of the fund, and it is a collection of stocks that are picked for you by a professional manager. Now this might sound great, and I'm not saying that it's not a viable option, but the reason that I myself don't really invest in actively managed mutual funds is that the fund managers will charge a series of fees. So first of all, they're going to charge you for their turnover fee. So that means that whenever they buy and sell a stock, it's what's called a turnover, and that is basically the cost of buying and selling. And they're going to charge you for that. They're going to charge you for their time. Literally just, they're going to take a percentage right off the top, and it's going to cut down your returns by 1 or 2% minimum in most cases, and over time that adds a lot of cost that is being taken away from your returns. And I actually made another video that addressed this called How to Set Up a 401k, and it basically gave an example of how through compound interest actively managed mutual funds can cut away a lot of your profits. And so for me, I just don't really like actively managed mutual funds because of all the fees that are taken off the top, and I find them to just give lesser returns than other options. And also in addition to that, in addition to the fees that they take, it's been historically proven that a lot of them don't even end up beating the market by picking their own stocks. And there's a whole very in-depth, complicated reason for this that I'm going to do a separate video on. But for now, I'm just going to leave it at most actively managed funds don't beat the market, and then on top of that, they charge fees. So that leads us to our next option, which I consider to be much better, and that's investing in an index fund. Now, an indexed fund works pretty much the same way as an actively managed fund in the sense that it's just a collection of stocks, so you don't have to do any work. You just put money into the fund, and you receive the returns of the average of all of these stocks. But the difference between the index and an actively managed fund is that an index is just the broad market collection of stocks, right? So instead of someone being out there actively choosing and picking and buying and selling various stocks, it is all the stocks in a given market. So for instance, if you invest in the S&P 500 index, that is tracking the 500 largest companies and literally just buying and selling from those 500 largest companies, and you'll get the returns that are the average of those 500 companies. You have an option to do the NASDAQ index. It does the same thing, except for the companies that are specifically in the NASDAQ index, which I believe is about 2,000 companies. You can do the same thing through the Dow Jones Industrial Average, which is 30 of the largest companies, and each index is basically just a broad representation of that nation's market. So to buy an index is basically to be betting on the American economy, or should I say investing in American economy. And I consider this to be a really good approach if you're wanting to just be very hands-off and not have to do anything or really learn anything. I use it myself for a lot of my funds. I really like it. The only downside that you might have with investing in an index fund is that you have to have a certain period of time because the market does have fluctuations up and down, and sometimes it's for very long periods, sometimes for 10, 20 years at a time. It doesn't actually give you that much of a return. It could stay very flat. You have, recessions like in the Great Depression or in the crash of 2000 or 2008, and this does happen. Now, the good thing is that it does, without fail, rebound. And over time, you should get somewhere between 7 to 10% a year compounded, which is phenomenal. But like I said, you have to be able to have a long span of time to do this to make sure that you're getting your money back. So for me, as a 25-year-old, it's a really good option because I'm going to be doing this for the next 30, 40 years. So I pretty much can't go wrong with this option of investing in an index fund, but it might not be the best option for someone who is older and closer to retirement who doesn't have as long a span of time to invest. Also, if you are going to invest in an index fund, there's a concept that, in my opinion, you should be using called dollar cost averaging. And what that means is that instead of just buying a big chunk of an index fund and waiting 30 years, you should be buying smaller portions over time. For instance, instead of investing $50,000 one year and just letting it sit there for 30 years, you should instead be investing, a few $100s a week and be doing it consistently every week. And here's the reason for that. Let's say you invest $50,000 and then the market crashes. And yes, eventually over time, it should be able to return and go back and higher past the point to where you invested in, so that you should be able to get a decent return on it. But what would have been way more effective is to invest $100 this week and then $100 the next week when it crashes. And basically the idea is that you'll be buying every single week as it gets lower or higher. And once that averages out, it will give you a much higher return than just hoping that when you buy all of it at once, it's the right time. So it's basically the concept of you're investing weekly and getting the best average that you can instead of just hoping that you're investing at the right time. And it takes out a lot of the error that you might encounter by just buying an index fund. So again, dollar cost averaging by buying an index fund, specifically one tracking the S&P 500, I think is a great option, especially for people who don't want to have to learn anything, which I totally understand. The third option, and what I consider to be the best option, is value investing by stock picking. And basically what that means is that you are doing your research and you are finding businesses to invest in at a good price and holding that business for a long time and reaping the benefits from it. And it's basically a somewhat sophisticated version of stock picking is all it is. And the reason why I say that this could be the best option is that the other two options, you're just getting the average of a large quantity of stocks. And for this, you're actually able to do your research and be able to pick the best companies to invest in. And you're going to be getting your returns from those best companies. And you're not going to be getting returns from the bad ones who might not be giving you any return at all or even putting a dent in your money, right? You're not getting the average. You're simply getting the best of what you're investing in. And now for this, it is a lot of work because you want to actually be investing in good companies and you want to be able to learn how to do that. And I know for me, it's taken several months of learning and reading and basically just actively doing this and actively seeking out and learning it and reading financial statements to get an understanding of how it works. But what I'm going to try to do throughout this series is show you how you can, if you want to, be able to search for a stock and buy a single stock and do it effectively and successfully. And so there you have it. There are your three major options and what I consider to be the worst and best of those options. Now, please understand, I'm not an investment advisor. This is not investment advice because I don't know your situation. I'm not your fiduciary. I am simply stating my opinion and what I think is best and what's worked for me. This is for educational and entertainment purposes only. Now that being said, I'm going to go ahead and plug an awesome product here. This product is Pura Vida bracelets. If you can see it there, let me go ahead and get out of this box and show you what it looks like. So here you go. Here is Pura Vida bracelet. You can go ahead and get a hold of these bracelets by going to puravidabracelets.com. And when you get there, go ahead and use the code DelaneyLang20 at the checkout, and you can get 20% off anything in the entire site. Alright, well that pretty much wraps it up for today. I hope you guys enjoyed this video, and I hope it gave you a better understanding of your options that you have when investing in the stock market. So please like, comment, subscribe, share for more content, and I'll be posting more videos about how to go about investing in the stock market and specifically picking your own stock. I hope to see you next time. Have a great day. I'll see you later. Bye.